Most traders don't lose because they can't see candles. They lose because they don't know what kind of move they're looking at. They see one strong rally and call it a new uptrend. They see one sharp drop and call it a market crash. They see one breakout in one chart and assume the whole market has turned. That is exactly where Dow theory still matters. Not because it gives you a magic signal, not because it predicts every move, but because it forces you to stop reacting to noise and start reading structure. If you don't know the difference between a major trend, a temporary counter move, and day-to-day noise, you'll keep buying corrections, shorting recoveries, and getting trapped by moves that never had enough confirmation in the first place. So in this lesson, I'm going to break Dow theory down the way traders actually need it. Not as market history, not as a museum piece, but as a practical framework to answer 3 questions. What trend are we really in? Is this move big enough to matter? And has the market actually confirmed the turn, or are traders just guessing again? At its foundation, Dow theory says something very simple. The market is not random noise. Price moves in trends, and those trends can be read through structure. That matters because most traders start from the wrong end. They start with one candle, one breakout, one news headline, one indicator cross. Dow theory starts somewhere more useful. It starts with the question, what is the market doing as a whole? Because if the broad tide is rising, a lot of boats rise with it. And if the broad tide is falling, 1 or 2 strong charts usually won't save you for long. That alone is already a major upgrade for most retail traders. Dow theory gives you a 3-layer model. Primary trend, secondary trend, minor trend. Here's the easiest way to understand it. The primary trend is the real market direction. That is the big move, the tide, the broad uptrend or downtrend that can last a long time. The secondary trend is the move against that main direction. That is the correction inside the bigger trend. The minor trend is the day-to-day chop. That is the ripple, noise, short-term fluctuation. So here is the practical translation. If the market is in a primary uptrend and price pulls back for a few weeks, that does not automatically mean the bull trend is over. And if the market is in a primary downtrend, one strong bounce does not automatically mean a new bull trend has started. This is where traders get hurt. They confuse a secondary move with a primary reversal. That confusion is expensive. The old analogy is tide, wave, and ripple. The tide is the major market direction. The wave is the intermediate move. The ripple is the short-term fluctuation. That analogy is old, but the chart logic is still sharp. Think of it like this. In an uptrend, every meaningful rally should push to a higher level, and every meaningful pullback should hold above the last important low. In a downtrend, every meaningful decline should push to a lower level, and every rally should fail below the previous important high. So the first job is not prediction. The first job is classification. Ask, are we making higher highs and higher lows on the level that matters? Or are we making lower highs and lower lows? And is this move primary, secondary, or minor? That question alone filters out a huge amount of bad trading. Because when traders say, price is going up, that statement is incomplete. Going up on what level? A one-day bounce? A 3-week reaction? Or the actual dominant trend? Dow theory forces precision. Now let's get into the mistakes, because this is where the lesson becomes useful. Mistake number 1. Reacting to minor movement like it's a major event. A few green candles do not create a bull market. A few red candles do not end one. Minor trend is where emotional traders live. Primary trend is where position traders make their money. Mistake number 2. Calling every pullback a reversal. A healthy uptrend can still have a sharp correction. A healthy downtrend can still have a violent rebound. If you don't understand that, you'll keep fading strength too early and buying weakness too early. Mistake number 3. Trusting one chart alone. This is the big one. One move by itself is not enough. One market by itself is not enough. One breakout by itself is not enough. You want confirmation. Modern traders should translate that like this. Do not trust isolated strength. One index, one sector, one pair, one stock, one asset can look strong temporarily. That does not mean the broader structure has turned. When confirmation is missing, certainty is fake. Let's turn this into recognition logic you can actually use. A primary uptrend is not just price went up a lot. It is a strong advance, followed by a pullback that does not destroy structure, followed by another push that exceeds the previous meaningful high. A primary downtrend is the opposite. A strong decline, followed by a rebound, followed by another drop that breaks to a lower level while rallies fail to reclaim prior highs. Now add one more layer. Market phases. A bull market often moves through 3 phases. First, accumulation. Smart money buys while public sentiment is still negative. Second, a steadier advance as conditions improve and more participants notice the move. Third, public enthusiasm and speculation, where everything feels obvious, news looks great, and participation becomes excessive. Bear markets also tend to move through 3 phases. First, distribution, where informed participants begin unloading into strength. Second, panic, where selling accelerates hard. Third, discouraged liquidation, where bad news spreads, confidence disappears, and late sellers finally give up. That is extremely useful for traders, because the chart and the crowd usually move together. If the public is still disgusted but structure is quietly improving, that can be early trend change behavior. If the public is euphoric and weaker quality names are flying while leadership starts hesitating, that can be late trend behavior. So Dow theory is not just structure reading. It is also participation reading. Here is the practical rule set. Do identify the primary trend before you think about entries. Do separate the big move from the corrective move. Do wait for structural evidence instead of labeling every bounce or drop emotionally. Do respect that counter-trend moves can be sharp without changing the main trend. Don't treat noise as signal. Don't assume a reversal because one market or one chart moved first. Don't confuse a strong rally in a bear market with a confirmed bull market. Don't buy late just because the move feels obvious and everyone is finally excited. Now we come to the heart of the whole lesson. Confirmation. This is what separates Dow theory from emotional chart reading. One move alone is not enough. One breakout is not enough. One relative strength move is not enough. One market leading is not enough. You want to see agreement. In modern chart language, confirmation means the move is not isolated. The broader market structure supports it. Related markets are not contradicting it. And price has done enough to prove that the previous structure is actually changing. This doesn't mean perfection. It means evidence. And that mindset saves traders from one of the most common traps in the game. Early conviction without enough proof. Before you label a move as a real trend change, ask this. What is the primary trend right now? Is this move primary, secondary, or minor? Are higher highs and higher lows actually forming on the level that matters? Or is this just a reaction inside a bigger decline? Is the broader market confirming the move? Or is one chart moving alone? Are we early in accumulation, mid-trend, or late in public excitement? Am I trading structure, or am I reacting to emotion? If you can't answer those questions clearly, you probably don't have a high-quality read yet. Dow theory is not popular because it is flashy. It is useful because it teaches discipline. It teaches you to stop worshiping every candle, to stop calling every bounce a new bull market, to stop confusing movement with trend. The market always gives you motion. It does not always give you confirmation. And if you learn that difference, you immediately become harder to trap. So the next time price surges, don't ask, how high can this go? Ask better questions. What trend am I actually in? What level of movement am I looking at? And has the market truly confirmed the turn, or am I just watching another wave inside the same tide? That is where better chart reading starts.